Good evening, members. I welcome you all for this study circle meeting on the topic critical aspects of annual filing before the ROC. And to dwell upon this subject, we have CS Narayan Desai. Can I request our Vice Chairman, CA Pramodar Hegde, to escort the speaker on the dais and then welcome him with the floor. Privilege in introducing today's speaker, CS Narayan Desai. Narayan Desai is a fellow member of ICSI and a company secretary in practice. With over a decade of experience, he has contributed to the compliance growth of foreign subsidiaries, listed Indian companies, government companies and startups at large. CS Narayan Desai practices in company law, investment and funding compliance, ESOP implementation and dispute resolutions. He has worked on a number of funding compliances in all sorts of transactions such as equity, CCPS, convertible debt instruments, including drafting and vetting of term sheets, shareholders agreement and transaction negotiations. He has previously worked at PS Rao and Associates, Hyderabad, a firm of company secretaries, and has been a faculty for company law and allied laws in various coaching institutes for CS and CA. He is also a regular speaker at various forums like ICAI, ICSI, ICMAI, CPE chapters, etc. on corporate law matters, and is a continued student of company law. He has a bachelor's degree in business administration from Dr. A.V. Valiga College of Commerce and BBA, Kumta, which is affiliated to Karnataka University, Dharwad, and has studied law from GK College of Law, Hubli, which is affiliated to Karnataka State Law University. With this brief introduction, I present before you CS Narayan Desai. Over to you, sir. Good evening, everyone, and thank you for the introduction. These days, we are frequently getting the opportunity to listen to some of the news like, hey, that company got notice of registrar for certain lakhs of penalties, certain irregularities. Regional director has levied 50 lakhs of penalty on company and directors. ROC has levied penalty on company and directors, including company secretaries, officers reporting of lakhs and crores of rupees. That makes us to think, of course, Companies Act is not a new act. We had a previous Companies Act 1956, wherein we had 50 years of legacy on that act, and which was a very settled law. And then Companies Act 2013 came. Now we are in fact celebrating the 10th year of new law. Though it is 10 years past, we are still calling it as new Companies Act. So, and very recently, maybe some last 4 or 5 years, we get to hear these news like what we have spoken. Adjudication, penalties, compounding of offences. Did we had the registrar of companies previously? Was the office of ROC established only under the Companies Act 2013? No, obviously. We had the companies, the entire Companies Act was subject to registrar's purview. And we had a number of occasions, the registrar was working only as approving authority previously. You file the forms, be it incorporation, be it change in particulars of directors or annual filing or whatever, 100 other steps. Registrar was primarily acting as approving authority. But under the new Companies Act, which is also termed as delegated legislation, most of the responsibility of registrar, which was there in the erstwhile act, has now been shifted to professionals. So it is not like the approval process or the checking process is done away with. No, it is still there. But registrar is no more just a approving authority.
if you see, most of the forms these days are processed under STP mode, straight through processing. Then who is checking it? We, the professionals who are certifying these forms, stating that the contents mentioned in the form are true and correct, and we are uploading it. And most of the forms, as I was mentioning, are STP. It is approved by the system based on the certification of the professional. Then what is that registrar is doing? Like how we have in our income tax, you file the returns with your self-assessments. Then the scrutiny will come sometime later, maybe 2 years, 3 years, whatever it may be. Now that is how even the ROC office is functioning these days. Which means the form gets approved by its own the moment when the form is filed with the certification of a professional. But you have every possibility of receiving the notice from the registrar at a subsequent point of time. And surprisingly, these notices are coming with not just few thousand or few hundred rupees of penalties, it is coming in lakhs. I can share a couple of instances. Bangalore ROC has levied penalty on some companies for not mentioning the phone number and website address in the letterhead. Very recently, in the month of October, we have that on the screen in fact, Regional Director Chennai has adjudicated a matter which was before him for the merger application. Two companies were getting merged and they had filed certain applications before them. And the Regional Director noticed that some 2020 or 2021 balance sheets were signed by the directors, auditors, everyone through a VC meeting, and was signed on the same day where directors are sitting at different places and the auditor is sitting at a different place. Now I believe obviously that is possible given the technology that we have in the today's system. The document can be circulated over the email, the same can be signed through digital means. But we have a penalty order by the regional director, adjudication order by the regional director stating that, hey, your auditors are sitting in different places and your directors are sitting in different places, and you say the financial is approved, signed on the same day. Maybe it is approved in the VC meeting, but it is signed on the same day. How it is possible? I don't agree with this. And we have adjudication. Now, this comes from the same officers who were there even since 1956 Act. Now, this shows the importance of the document and the details that we end up with filing before the registrar. The penalties that is being levied by the government, the adjudication orders being processed, the penalties being levied, at the same time making the companies and directors ineligible to access the capital market. There are certain restraint orders on the directors and companies that they cannot access the capital market. Now this applies to even listed companies to largest extent. Given that background, let us study on the annual filing. I will now, since the matter is serious, I will just put my mobile on silent and hope you also do the same thing. Given that we have now completed auditing period, now the next step is 6 months from the end of the financial year is over, and there is a season called ROC filings. By September we would have completed all our accounting and auditing. And AGM is also completed now that we are in the process of filing the annual returns. Now what are the basic minimum mandatory care that we have to take? That is something that I am going to discuss with you all today. With one big disclaimer. What is a disclaimer that I have? Probably none of the points that I am discussing today are new to any of you or all of you. We being professionals, being in touch with this industry, we have been always dealt with these provisions, acts, rules, regulations. But what I am trying to do today's presentation is trying to pick those aspects which are critical. And in my experience of working with the diligence processes, we also help in due diligence process for many of our clients, wherein we see the filings made by the companies defect on certain aspects, which also could attract the penalties, adjudications, compounding of offences, things like this. So today's discussion is limited to that extent. Of course, as you are all aware, Companies Act is a very big act, and if at all we start discussing on each point, we take not just a session, but maybe a marathon of sessions. That's why we call, as I was mentioning in the beginning, Companies Act, New Companies Act 2013. It's been 10 years now, right? So with that background, let us start the today's session, and I wish to cover the entire session in 3 parts, where second and third parts are, not that, I'm not saying important, but it's not that pressed upon. Whereas the first point, which is documentation, critical points that we have to observe while preparing the annual filing documents, be it report of board or the annexures to that and things like that. Then we will jump on to the procedural aspects as to what and all things that we have to consider while doing the holding the general meetings and subsequently, and then the filing requirements. Just maybe spend 5 minutes on the filing requirements, and then the floor will be open for discussions further. To start with, documentation. Why this documentation part is important for us? There is a Latin maxim which says that expressio unis est exclusio alterius. What is not expressly expressed cannot be implied. Or at the same time, it is also meant that expression of one thing precludes the other things. It's also that the meaning that we have. Why this Latin maxim is important for us to understand here? The documents that we are going to file with the registrar once the process of annual general meeting is completed and subsequently becomes an evidence. Evidence of what? Evidence of either compliance or non-compliance. So, if you have done the compliance, it is important for you to state that so and so compliance is done. There are a number of provisions under the law, not just under the Companies Act I am saying, the allied laws, the different laws, which states that if you have done so, you have to mention it in the annual report, in your board report. One of the points which I am coming up subsequently is something called DI certification, downstream investment certification. If the company has obtained such certification from its auditors, it has to mention the fact in the annual report. Right? So if you have not mentioned it in the annual report, that means you have not done that. So the document that you are going to file before the registrar is nothing but an evidence of either compliance or non-compliance. Similarly, when I say evidence, as I was mentioning, the DI certification requirement is not from the Companies Act. There is a disclosure requirement under the POSH, Prevention of Sexual Harassment of Women at Workplace. This is not a Companies Act requirement. Like this, there are various other reasons, other points, other provisions which require us to report the disclosures in the annual report filed under Companies Act. And hence it is important for us to understand the procedural aspects of documentation. While preparing these documents with proper checklist like this becomes in fact an internal audit or internal due diligence and acts as an opportunity for us to correct ourselves. For example, I get to say about this in many forums. When we prepare annual reports, annual documentation, this is like a post-mortem job. It is already done. Audit is completed, everything is done. Certificate of auditor is already issued with either qualification or without qualification if there are no qualifications. But let's assume there are certain matters which require you to take care from the Companies Act point of view. You had to pass certain resolutions. Now, this process of doing the annual filing correctly, the documentation part, helps us to check our own health. When I say our own health, health of the company, and then come back with the better perspective about the proper compliance that is possible. So this becomes the importance of the documentation that we are going to do for the purpose of annual filing. So let us try to understand now the different points that I wish to bring before you all on the documentation part. as to what and all are important. Number one, signing of documents in VC meeting. I was explaining the point at the beginning of my speech that the regional director has issued an order very recently that the company has failed to observe the relevant provisions. Where the auditor has signed, say from Bangalore, company's registered office is in, say, Hubli, where the directors are sitting in Dubai, or rather maybe one director is sitting in Dubai and another director is sitting in Delaware, USA. The time zone differences are there. With all these possibilities, can we have the accounts approved these days? Company has got only 2 directors and 2 directors are sitting in different part of the globe. Auditor is sitting in, say, Bangalore. Can we approve the accounts? Any possibility?
Digital signature we can do it.
Previously we had, yes of course, right sir. Previously we had a restriction under the Companies Act, section 179 of the Companies Act, which stated that of course you can have the VC meetings, but for certain agenda items you cannot have VC meetings. You were required to have the physical meeting for such items, like approval of mergers and amalgamations. Approval of account was also one of such agenda items which could not be passed through VC meeting. But thanks to COVID, the ministry first came up with a regular circular, a relaxation circular, stating that during the COVID period it is difficult for companies to conduct the physical meetings, and hence, even for approval of accounts like this, the meetings can be conducted through video conference. And they ran this circular for 2 years. And post this, ministry felt that hey, it is still possible for companies to approve the accounts through video conferencing. Why don't I make it as a law? And they changed the law itself. They removed that the restrictions under 179, wherein now it has become a law that the companies can approve the accounts through video conferencing meetings. Now this itself says that the directors are participating virtually, right? Now the law, one side it's saying that directors sitting in different part of the globe can approve the accounts. Now we know the process of approving the accounts, it's by passing a resolution specifically. Post approval of accounts by the company, the accounts are generally forwarded to auditors for their audit purpose. Of course, that doesn't mean that audit will start only after board approves the account. Audit process would have been started, but auditor would actually do the audit and issue his report only based on the approved accounts. Now that is also happening. If approval of accounts can happen through virtual mode, why not the audit process? We still have the same technology even for the auditors. Now that is also happening virtually. Subsequently, report is also now digitally signed. When I say digitally signed, obviously it can be done remotely, and subsequently we can take note of the audit report, then see the comments of auditor, respond to the comments of auditors in the board's report, 100 other items for all that. But the recent adjudication order speaks differently. It says there is a penalty levied on the company and directors for not observing the provisions of the Companies Act while approving the accounts and getting the accounts audited. The mistake that they had done was the document was physically signed, mentioning the different places, but on the same day. I would say that could be even still possible. We have Vande Bharat Express these days, where probably document can come from Hubli to Bangalore, and then auditor does the audit and then it goes back to Hubli, and yeah, that's still possible. But unfortunately, do we have that patience, and or even do we really want to argue these matters with the authorities? So the important point for us to take up here is, in case if the document is getting approved in a VC meeting, it is ideal to sign it in a digital form. If not, before this VC meeting concept also, there used to be a lot of companies where the board of directors used to sit in different parts of the globe and they audit auditor used to sit in India and audit process would be followed in India. The recommendation here is have a gap between the approval of financials by the board, that date, and the audit report date, so that these type of, the possible non-compliances will not happen. So either we have, in case if the document is approved through VC, everything should be signed in a digital manner. If the physical documents are the document is physically being signed and the parties are at different places, then definitely the signing of these documents will have to be on a different date, at least with the practical minimum gaps. Yes, please.
This for the physical documents, one director signs, scans it, sends to another director. He prints it out, scans that one, again sends it to another director. Then it goes to the auditor. He signs that one, whether it is valid.
I completely agree that this is valid, because signing is nothing but, it's authentication of approved documents.
Okay.
Signing doesn't mean that approval, right? Let us come back, let us just take a step back and try to see whether the director who is signing the balance sheet should also have approved the balance sheet. Let's assume a situation. Now I'm entering to the interpretation matter. Let's assume company has got 10 directors. And out of 10, 8 directors have approved the financial statements and we have the requisite majority. The financials got approved. Can the financials be signed by the remaining 2 directors who have not approved? Yes, possible. And why I am saying it's possible? Because you are now signing the approved financials. Signing doesn't mean that I am approving it. I alone cannot act, right? So, board is a collective body of directors. Board, individually director cannot take any decision. So when I am signing some documents on behalf of board, for and on behalf of board of directors of so company will mention that. Which means, even the director who has dissented the approval of financial statement can also sign it, that is still valid. From that background, if I see, the accounts are approved now, resolution is passed, and we have a valid accounts that is approved. Now when it comes to the matter of signing, one director signs it, as you rightly said, and then he scans it and sends it to the another location. There he will take a print and he sends. Auditor will do the same thing. I find absolutely no problem with that. But unfortunately, the ministry is not equipped to understand this. That's exactly what has happened in the order that I have, shown you in the first place. That's exactly the same thing. And I also believe that the same matter is not properly heard and no proper representations were made probably. But as I was mentioning, do we have either patience or do we really want to get into that mess in interpreting what is right, what is not right? So, critical aspects here is, in case if the document is approved through video conferencing, it is always best to use the digitally signed document. But I also have the practical problem with digitally signed documents. Of course, that is slowly getting down, but at the same time, banks may not accept the digitally signed document. They would want some document to be digitally signed. They have a different meaning of digital signature. Even copy paste of signature is also, in their case, it is a digitally signed document. Right? Because digitally signed documents are in fact valid in the digital form. When you take a printout, it's no more a valid document. You cannot verify the digital credentials. And that's why they would probably insist a physical signature, because you are giving a printed copy of it. And if it is so, the digitally signed copies also can be again re-authenticated on a different dates by all 3 parties and can be submitted to the relevant parties. We recommend that kind of approach rather than signing all documents physically on the same day at different locations. Even though that approach is, morally and legally correct in a way.
Valid in law.
It is valid in, there is nothing, I would not say it is valid in law, rather I would say it is not invalid under the law. But we still have to take pain of explaining this to authorities, which we might not want to. Right? That's why it becomes a critical point for it. Right? So jumping on to the next point, while freezing, finalizing the accounts and auditing, we are preparing the documents for annual filing now. One of the important points that we all miss is charging of interest. When a company has given loan to another. Now, giving of loan is a financial transaction. The moment when you start auditing, you see the accounts and you see bank statement. Even if you are preparing an accounts, you see the bank statement. Hey, there is 10 crore which has gone from company A to company B. What is this nature of transaction? No, there is a loan that the company has advanced. Then you will record it as okay, advance given to so company. And we forget it. There is a section called section 186 subsection 7 which states that it is not at your discretion whether to charge the interest or not. It becomes mandatory for you if at all a company gives loan. If I am as an individual gives loan to any other fellow, it is my discretion whether I should charge any interest or not. I charge 24% or 0%, it makes no difference. But when a company gives loan to another company, be it a closely held company, under 186 subsection 7, it is mandatory for you to charge interest. What interest? Interest which is equivalent to the government securities, the tenure of government securities. If it is the loan is for 3 years, then you have to take the interest rate of government securities for 3 years in that year. At least of that you have to charge as an interest. Now comes the problem. Charging of interest is not a big problem. It is just an accounting entry. Okay, I have missed it, now I charge. Now I charge it. Now that fellow, the borrower has to pay it. TK, he has not paid it, he will pay in the subsequent, while repaying he will pay. But how are we going to comply with the provisions of TDS? Because if interest is charged, interest is recognized, then you will end up with paying TDS. Whether or not it is paid, it has to be deducted and remitted to the government, at least the TDS portion. And in case if that is not done, that interest becomes inadmissible expenses and 100 other things your chartered accountants you know better. 186 subsection 7, some miscellaneous point he said, interest should be charged mandatorily and we don't have flexibility of not doing it. Another draconian provision under the same section is, in case of default, the company will end up with having whatever the penalty, and now since there are two companies involved here, borrower and lender, the provisions are applicable to both the companies and hence both the companies will be under the umbrella of non-compliance. Not just under the Companies Act, as I was mentioning, this is also dragging to the TDS provisions and thereby whatever the report that auditor has to qualify in his report. I'm dragging, this is a critical point for me. Interest is not charged becomes a ultimately qualification in the report, auditor report of a borrower, company and lender. And that's why it becomes important. And not just that. Now you have given a loan, somebody has borrowed, you have charged interest, everything is fine. What purpose that borrower using that money? Now money has gone out of my bank account. But once it has gone out of my bank account, what purpose he is using? That has to be mentioned in your financial statements. Wow. Many of us are doing this. The purpose of money borrowed by the borrower, I am lender. For what purpose he is borrowing, for what purpose he is using it, is something that I have to mention in my financial statements and disclose it to my shareholders. That becomes an important critical aspect while preparing the documents for an inquiry. When I say document here, the financial statements and related disclosures. If not, what will happen if the secretarial audit is applicable, then secretarial auditor will qualify, and you under CARO 185, 186, you also qualify that so and so provisions are not observed. And if not qualified, we get to hear from ROCs in a couple of years, because that's where the ministry is targeting. They have done their homework now that companies you cannot hold more, so they are now targeting the professionals. Very recently, I will tell you one example. MGT 7 annual return was filed by the company, where one board meeting detail is not mentioned. The company secretary who has certified that is penalized for not disclosing the board meeting date. How big this non-compliance is? Does this have any big impact on the public at large? No, absolutely not. But yes, so this has become important, and hence understanding the provisions of law, this critical point of disclosures, and if it is not disclosed by the company for some reasons, as professionals, bringing these points, relevant points in the respective reports, this also has become a very important point. So hence, this becomes a critical point. Next important disclosure, important critical point in the preparation of annual reports, annual documentations is ESOP implementations or ESOP disclosures. I'll tell you the problem with ESOPs. ESOPs are non-financial transactions. As accountants, as auditors, we go each bank statement, each entry, and everything is done. Financial accounts are prepared, financial statements are prepared, everything is finalized. We are in the stage of final audit. And also subsequently, obviously, disclosure in the reports and filing with the ROC and other stuff. One big point that is missed, which has got multiple implications, say ESOP. Many of us, we don't have in our checklist of audit ESOP as one of the important concepts. We don't have it at all. But unfortunately, Bangalore being definitely the startup hub, most of the startups these days have ESOP commitments. Sometimes they have a proper scheme and implemented everything, and sometimes they would have just agreed something on the offer letter that hey, you are eligible for 1% ESOP, 2% ESOPs, 100 other things. No. What happens if you don't recognize the ESOPs in the first place, and what non-compliance and what impact it will have? Number one, obviously, whenever ESOP is granted, it is required to ascertain the ESOP cost. We have to take a registered valuer's report on the date of grant or nearest to the date of grant and ascertain the cost of granted ESOPs. Recognize that expense in the P&L and also disclose the facts of how many options are granted, how many options are vested, how many are lapsed or yet to be vested. All those points we have to give a disclosure. And this disclosure will be definitely forms part of the notes to account. And not just notes to account, even under section 134, even the board report has to contain disclosure. There is a specific format he has given. What and all disclosure they have to do. Unfortunately, what happens is, since this ESOP costs are recognized at the time of grant. Now, when grant happens, there is no financial transaction. No money is coming into the bank account of the company or no money is going out. No allotment is being filed. Nothing. And being private limited companies have exemptions of even passing a special resolution for ESOPs. Even if you search in the ROC website, first of all, if at all you are successful in searching in the ROC website, you will not find any filings with respect to ESOPs because ESOPs are not with special resolutions. In case if there is a special resolution, company would have filed NGT 14 and things like that. ESOP implementation, say private limited companies, are not even special resolution, it's an ordinary resolution. And hence you will not find this in the ROC website also, in the public inspection also. So you don't have public inspection information, you don't have financial transaction, and if you ask some audit person or account head in the company, he would probably hardly have any idea about company issuing ESOPs to any of their employees. Yet company in its all communications to that employee and board level, investors level and all, they would have already said, hey, I have 5% ESOP pool and out of which I have used 3% ESOP to be granted to so and so person. And I get many times a request from my clients, Mr. Desai, I have committed this fellow ESOP of 500 shares. Now I want to give it to him. What should I do? And I would have already, and he is there in the company from last 3 years, I want to give it to him. And I have committed at the time of his joining itself. When did he join? 3 years back. In the last 3 years financial statements and board report when I see, there is no ESOP. There is no clue of company having ESOP. Then he comes with, no, I have a ESOP scheme, see this is a grant letter, this is, everything is almost offline. When I say offline, it is not come to the limelight, right? So unless as auditors we ask for ESOP details, ESOP grants, we don't have that information at all. And let's assume critical point here, another critical point. Assume we came to know about this ESOP grants in the subsequent year, next year, next to next year. We now have the ESOP grants which is done 2 years back. First of all, whatever the disclosure that we had given, that is wrong. Number two, even if I want to recognize that expense today, that becomes ineligible because that is a prior period experience for me, prior period expenses for me. And that expenses I cannot claim. Now that company has even lost the tax benefit out of it. Whatever the beauty of ESOP implementation, one of the beauty is the tax advantage for the company. They can claim the expenses without actually incurring that expense. Now that has gone. Prior expenses. That is why the ESOP point becomes important for me while preparing the annual filing documentation, which also includes the financial statements. Why I have brought this 1, 2, 3, 4 points in the first place, you being auditors, chartered accountants, is these points have impact both on director's report, of course, and also as well as the financial statements, be it in terms of signing of documents through DC, interest given, ESOPs. This point has got impact on the financial statements as well. Hence, it becomes utmost important for us to include it in our audit checklist of these points and make sure that we don't miss, because preparation of financial statement is the first step in annual filing documentation. And if we fail to recognize something in the first step, the default continues in the subsequent steps as well, because the first step itself is wrong. Let us be more clear on that. Next important and critical aspect is consolidation of accounts. Now we all know generally we have a fair understanding of consolidation of accounts. Consolidation is required specifically under Companies Act if I want to bring. Consolidation is applicable for subsidiary companies, and for the purpose of consolidation, even associate company is considered to be subsidiary. Very clear. This is 10 years old law, hence we are clear. But what is not clear here is, again critical point, we see subsidiary only from shareholding perspective. If at all you are filing XBRL, XBRL has got a specific taxonomy which says that do you have subsidiary? Yes, I do have subsidiary. In case if yes is selected over there, it has section under which you became a subsidiary. Which means there are other means of becoming a subsidiary. What are those other means of becoming a subsidiary? Of course, we have more than 50% shareholding in the company. We became holding company, and that company becomes a subsidiary company. But there is another provision which says that in case if you happen to control more than half of that board of directors, even in that case, that company is a subsidiary company of you. Wow. And I tell you 100 ways of how this can happen. Assume that company has got 10 directors and you have, under a shareholders agreement, right to appoint 3 directors. Of course, you don't have right to appoint majority of the directors. But out of 10 directors, 5 directors have resigned during the year. Now there are 5 directors left, out of which 3 directors are appointed by you and 2 directors are independent directors or promoter directors. More than one half of the board of that company is now being controlled by your company, which means this company now becomes a holding company. Are we observing this? And the moment when holding company, subsidiary company relationship is established, number one, of course, we will no more become a small companies. We are now out of the small company definition, which means cash flow statement and other reporting requirements are applicable for us. If earlier I was small company, but now because of the holding subsidiary relationship, I am no more a small company. That is one point. Second point is, though there is no shareholding between this company and that company, or even if there is a minority shareholding, because of the control exists in the board, now I have to consolidate the accounts of that subsidiary. This is a critical aspect for me. Again, provisions also continues to say one more important point which many of us we have ignored. In case if company has a foreign subsidiary, again when I say subsidiary, quote unquote, subsidiary includes both the type of subsidiaries here. Subsidiaries by shareholding and subsidiaries by board control. If company has a foreign subsidiary which do not have operations in India, while filing the annual return, while filing the annual accounts of the company, you should also file the standalone financial statements of each of those foreign subsidiaries. We missed this. We are doing consolidation of accounts, no? All those accounts are already consolidated into my consolidated accounts and I am filing the consolidated accounts. I am in full compliance with the law. Are we filing the standalone financial statements of those foreign subsidiaries which do not have operations in India? This is law. This is not even a circular. This is not even some miscellaneous provision in some corner of the website. The ministry has said, no, this is law. And we tend to miss it. What is the checkpoint for us here? Checkpoint is very simple. Yet this is not applicable for Indian subsidiaries. So the companies which are subject to APR filings, APR is applicable only when you have ODI, Overseas Direct Investment. So have a list of your clients who are doing APR and make sure that those clients will also file along with their standalone and consolidated accounts, standalone accounts of foreign subsidiaries which do not have operations in India. This becomes, adding this to the checklist, becomes one of the important aspects while doing the annual filing before the ROC. If not done, then the filing that, the immediate threat I will tell you, the form that you have filed before the registrar is eligible to be rejected. And registrar will probably do this after 4 years, 5 years. And he will ask you to refile it. And when you are supposed to refile it, first of all, the immediate threat I am saying, the filing fee that ministry is going to take is per day 100 rupees from today without any upper cap limit. Of course, this 100 rupee per day is not new to you all. Even in TDS and other things we have it. But there is an upper cap limit. To the extent of your liability, the penalty is restricted, the additional fee is restricted. Whereas under the Ministry of Corporate Affairs, the upper cap limit is not there. I have a client who has just paid 25 lakhs as penalty as in the form of additional fees, which otherwise in time if he had filed could be around 2,500 rupees. So that is threat number 1. And threat number 2, obviously adjudication, compounding, penalties and 100 other things. So this hence becomes important for us to understand while doing the annual filing documentation of any company. Then on the other hand, while we have the consolidation of accounts which pertains to the financial statements, there has to be a filing of form AOC-1, which is an abridged form of consolidated details that we will end up with filing. Very critically, he has used some words in the AOC-1, last line. He says, the AOC-1 is required to be certified in the same manner in which balance sheet is getting certified. Which means AOC-1, lot of companies are filing it as an annexure to the board report, annexure to the financial statements with only the signature of directors. Whereas financial statement is signed by not just directors, right? It is also signed by the auditors. Whether AOC-1 is also signed by the auditors. And looking at the scenario of ROC sending notices for not mentioning the website address or full name of the company in the letterhead of the company, AOC-1 not getting signed by the auditor is a big mistake. AOC-1 and AOC-2, AOC-2 is with respect to related party transactions he has given. There is a difference in the language he has used there. AOC-2 he says this has to be filed, signed by the directors, it has to be filed. Whereas AOC-1 he has used the word certify in the same manner in which the balance sheet is getting certified. Which means AOC-1, even we had a big argument on this particular provision even with the big folks where they said no, we are supposed to do only financial accounts signatures, not on AOC-1 at all. No. auditors are also required to certify AOC-1, and this becomes their duty. Now I drive your attention to 141 of the Companies Act. Duties of auditors. Auditing is one of your duty, right? So you being auditor, if law says auditor has to certify, this means you have to certify even AOC-1 in case if that is applicable. And hence, that becomes one of the critical documentation while doing the NFIT. Next important and my favorite subject, in fact, yes sir, sorry.
All these formats are now we made digital.
Correct.
We don't find physically. So if auditor signature is required, there should be provision in the format for the auditor to sign.
Right.
Digitally sign. So if it is not there, your pre-scrutiny will fail. So then it's not possible to.
So
if the format doesn't ensure that, then you can't say that it is a fault of
Small correction over there, sir. AOC-1 is not a e-form. AOC-1 is a physical form. It's a form of certificate. AOC-1 is now being filed with the e-form called AOC-4. AOC-4 is a e-form.
Yes.
Whereas, like exactly what you said, let's say for example DPT-3 if you are filing,
Yeah.
and DPT-3 requires a certification of auditors. The form will not be filed unless the auditor has signed it.
Sure.
That check is there. Why that check sometimes works, sometimes doesn't work, that is a different issue. Maybe this is not right forum to discuss on that, but yes, what you said is right. But this AOC-1 is a physical document. So it is filed as an attachment to the e-form, and we fail to get it certified by the auditors. Next important point that we have is office or place of profit. Under erstwhile Companies Act 1956, there was a section called Section 314, but now that is merged with the related party transactions, Section 188. Something called office or place of profit. Most of we professionals fail to observe this. What is this office or place of profit is? He has given an explanation. There could be a possibility of office or place of profit in two ways. One is this office being held by the director and this office being held by the person other than director. And stop me wherever you get confused, okay? Do not hesitate. What is this office or place of profit held by director and held by relative of director? Very simple explanation is, if director is getting anything from the company over and above the remuneration which he is entitled to as director. If I can further simplify it, if director is getting anything over and above what he is entitled to as director, which means see, director remuneration we pay. Director remuneration is not a related party transaction, and I am not speaking about ES18 here. I am speaking about Section 188 of Companies Act, which speaks about a different related party transactions. ES18 is a big area. Everything under the umbrella of related transaction between related parties covered under ES18. Whereas 188 speaks about some certain transactions which leads out certain transactions which are called as related party transactions. Remuneration is not one of that. Direct remuneration is not one of that. Section 196, 197 and all are governing the remuneration. How much you can give, how much you cannot give and all is mentioned over there. So anything above, over and above what he is entitled to as director if he is receiving. For example, I am a director of a company. I am running a software company, and this is very common these days that software companies get to select the cab facilities. And I also have some 10 cars with me and I run a cab facility for the company. I am getting remuneration. Let's assume I am getting 1 crore remuneration per month. Fine, that is not a related party transaction. But if I am getting cab rentals from the company, that becomes a related party transaction. And now that is for the purpose of Section 188 called as office or place of profit. Another classic example of office or place of profit which I am 100% sure all of you have seen is director's relative is getting salary from the company. Right? How many of us at least we check this? Director is getting salary, fine. Director's brother who is not in the management of the company, but he is also drawing salary. Director's wife drawing salary. Director's immediate relative, any of them would be drawing salary. And we see all the compliances, whether PF is paid, ESI is paid, all the employment laws and everything, whether that is done or not. But that attracts office or place of profit in the first place. And what happens if office or place of profit is taken? Number one, you need to pass a unanimous approval of board of directors. This is one section under the Companies Act where you just cannot have majority approval of directors. You need to have unanimous approval. All the directors should approve these transactions. Additionally, if this amount exceeds 2,50,000 rupees in a month, which is considerably small amount these days, right? 2.5 lakh is not a big amount. You have to also pass a shareholders approval, shareholders resolution. Of course, private companies can pass a shareholders resolution, but yeah. Now, why I'm pressing this office or place of profit? I said, in the first example I said, I have given the example of lease of cars. No, lease is a separate transaction under 188. You might have a question back in your mind, corner of your mind that, this lease is already a related party transaction separately charged. No, why are you again taking up it under the office or place of profit? I'll tell you why. If you refer the rules, you are required to pass shareholders resolution only if the lease amount is exceeding 10% of your total turnover. Am I right? This is what the provisions of section 188 read with rule says. Now assume I am doing 100 crore turnover. My 10% is 10 crore. And I am not paying lease rentals of more than 1 crore rupee per month. And hence definitely I am not required to take a shareholders approval under 188 subsection 1 clause 1, 2, 3. But under clause 4, if that amount happens to be more than 2,50,000 rupees a month, it is not crossing 10%, I agree. But if it is crossing more than 2.5 lakhs a month, which is considerably small amount, that becomes office or place of profit and you are required to take a approval. Private companies, fine, no problem because it's still an ordinary resolution and you know why I said fine. But when it comes to public companies and listed companies, definitely that is not possible. And we escape this particular point, we will miss this particular point from the office or place of profit point of view. And related party transactions and violations and related party transactions are one of the severe violations that could also trigger, in some cases, vacation of director as well. Because he had to disclose the interest. Disclosure of interest is mentioned under a section called section 184 and it's like a jalebi, okay? This is linked to section called section 184. Now this section 184 is linked with another section called section 164. What is it 164 is? It is a draconian provision under the Companies Act which says that how a director can become disqualified. We don't have qualification for directors. There is a qualification for say company secretary, there is a qualification for auditor. To become a director there are no qualifications. However, there are disqualifications to become a director and one of the disqualification is director not disclosing his interest. If his relative is working in the company and he is not disclosed to the board and subsequently also to the auditors for the purpose of reporting, he becomes disqualified. And you know what happens if he becomes disqualified? For 5 years he cannot act as a director. And he will also vacate the office. There is another section called section 167. A director who is disqualified under 164 will vacate under 167. Which means office or place of profit can also lead to a situation where director will lose his office, director will lose his position, and hence this becomes an important documentation for me. Then one more important disclosure under the annual filing documentation is disclosure of facts of company obtaining DI certifications. What is this DI certification? This is something new again. Again, one more responsibility of auditors. Downstream investment is one compliance under the FEMA. As I was mentioning, this annual report documentation or annual compliance documentation is not just limited to Companies Act anymore, right? Now we have a FEMA Act which says that if there is a downstream investment, and I'm sure you all know what is downstream investment. You have received a FDI, and that FDI recipient company is further doing investments subsequently, right? Now that amounts to DI, downstream investment. And if that downstream investment is done, there is a requirement under the FEMA that the company has to obtain a certificate from its statutory auditor, not just any chartered accountant, from its statutory auditor that the company has complied with the FEMA provisions with respect to downstream investment. And it is not just sufficient to obtain a certificate. The fact that you have obtained a certificate and you are in compliance with the DI regulations is also required to be published in the annual report to the members. Now that becomes one of the critical aspects of we preparing the annual filing documents. Next we have related party transactions. Again, I'm coming back to the same point. Again, when I mentioned related party transaction, for the purpose of today's discussion, RPTs are not as per ASAT. RPTs are as per 188 subsection 1. We give this disclosure in the financial statements. We have a separate section related parties. We give disclosure of related parties, nature of their relation, and the transactions, opening balance, closing balance, transaction during the year. Everything we give. We have a format. We will hardly forget to disclose that. Fine. But there is one point. These related party transactions, if entered by the company is also required to give justification for entering such related party transactions in the board's report. Wow. This we are not doing. What justification we are giving? We are not giving any justification. Are we? No. Non-compliance under section 188. But there is one relaxation. There is one big relaxation. If it says, anything in the ordinary course of its business and in the arm length pricing, then the provisions of section 188 subsection 1 is not applicable. But I will tell you something more. Yes, there is a relaxation. This is the interpretation matter, okay? There could be different views again. But section 188 subsection 1 is exempted for those transactions which are in the ordinary course of business and at the arm length pricing. Fine. I am not doing any compliance under section 188 subsection 1. But this disclosure requirement is not under section 188 subsection 1. What it is? Section 134 says company have to disclose all those transactions along with the justification for such transaction in the board report. Which transaction that is? Transactions referred under section 188 subsection 1. He says not this transactions which have suffered the compliance of 188.1. No, he is not saying that. He says transactions referred under 188 subsection 1, which means these related party transactions under those 6 headings are required to be disclosed. Say for example, you have an office or place of profit. Director's brother is getting a salary from the company. That salary is less than, let's assume, 2,50,000, or even if it is more than 2.5 lakhs per month, you have taken on order resolution, special resolution, whatever it may be, you get the complaints. But coming back to the board's report while doing the annual filing, you are required to give a disclosure and justification for that related party transactions. Failing which, 188 is not violated, but provisions of 134 is violated, which again we are all certifying professionals while doing the annual filing. That the contents of forms and its attachments are true, correct and perfectly fine. And fortunately, of course this is not a relevant discussion, but in the form, if you have observed, every form generally closes with one statement. Attention is drawn towards the provisions of section 447 of the Companies Act for the statements. What is 447 of the Companies Act? Fraud. What? I am not disclosing one detail in the board report and you are calling that as a fraud. Unfortunately, yes. That is a fraud, and punishment fraud, you read section 447, you will realize. That also includes the imprisonment. And that serious it is. Then we have filing of AOC 2. Why this is critical? We have already discussed, but why this is critical, I'll tell you. AOC 2 is disclosure of related party transactions as an attachment, as an annexure to the board's report. But in AOC 2 we have two parts. One is related party transactions not at arm's length pricing, which means you have done all those compliances and all, you give the details of that. But most of the case we say everything is at arm's length pricing, we have done those compliances. But there is, and hence we say section 188 is not applicable for us. But there is another section which says that material part B, material related party transactions at arm's length pricing. You have to disclose those facts, those transactions which are though at arm's length pricing, though at proper pricing and other things, but if it is material. Now what amounts to material transaction? Let's assume we have a cost center in India. We have a subsidiary company of a foreign holding company, and Indian company is just a cost center. They are just doing say development and other things. Most of these companies operate on a cost plus markup basis. And we have all this TP arrangement and everything. We have a TP study, we add a markup, say 15%, 20%, whatever it may be, and we do. And when we say that there is a TP arrangement, we say all transactions are at arm's length pricing. We are booking the minimum margin and everything is done. TP audit is also successful. Arm's length pricing. But that company is doing transaction mostly with only the holding company. 100% of its transactions are related party transactions, maybe in some case. That is a material transaction. Right? There is a question now. Now should I give the disclosure of these material transactions to ROC? Each and every transaction that I entered with holding company? No. There is a relaxation again. If you read the act, what it says is, now AOC 2 is a compliance under section 188. Now what it says further is, part A, transactions not at arm's length. Part B, transactions at arm's length but material in nature. But if it happens to be so that these transactions are in the ordinary course of business, again you need not. Though it is material, but if it comes under the ordinary course, what is meant by ordinary course? Now this new question comes. Probably doing what is there in the MOA object clause is called as ordinary course of business. Right? So transactions which pertains to that, you can exclude that, fine, no problem. But anything apart from that, it has to be disclosed in the board report. Then I will move on to the next point. Change in KMP. Change in KMP is fine. Key managerial persons getting changed, this has to be disclosed in the board report. But why I am taking this as a critical point? There are 100 other points in the board report. Why I am taking this as a critical point? I'll tell you why. This is the only section or only clause in the entire Companies Act which requires you to disclose something in the annual report in respect of the events even after the financial year, completion of financial year. Generally, your audit report is for the year, April to March, say. Director report is prepared for the year. Everything is prepared for the year, like till 31st March, cut-off date, right? Any disclosure that we give is with respect to that financial year. But this change in KMP is one exception to that. Change in KMP is required to be disclosed not just during the financial year, but also after the end of the financial year, but before the signing. So even during the current year, if there are any change in the board, that has to be reported in the board of directors. Now why this is a critical aspect? If there is a disclosure, we will do it now. But there is one habit, more specifically in the startups. What is that? Doing backdated resignations or backdated appointments. Now you being professional, who has signed the audit report and who has certified the E-form AOC-4, in which there is a director's report, which states that the company has so and so change in the financial year and there are no other changes during the financial year and subsequent to financial year. You mention the specific line, you are required to mention the specific line. But after you signing, after you filing this AOC-4, everything is done, you have raised your bill, client has paid you also, And the client is now coming up with saying, hey, I want to resign so and so director effective from June. And most of the cases, he himself is a professional now these days, right? He would have filed also DR 11. Where is the compliance? And hence, this becomes important. During the year, you have a control. During the year, whatever that has happened, you have a control. But this is one exceptional point which require you to report even after the closure of the financial year. And hence, this becomes a critical point in documentation.
Sir,
Yes, sir.
this is for about 18 months period. You say,
Yes. In a way, it becomes for 18 months.
But supposing somebody has resigned previous year in 2022,
Ah.
June,
Ah.
it gets reported in the previous report also, it gets reported here also.
Absolutely right. Absolutely right. In the previous reporting, it gets reported as a post-financial year activity, and in this report, it is during the year. Absolutely right. Moving on to another critical and at the same time draconian point under the Companies Act called loan from directors. This is a very common point. Business starts with loan from director, I say. Right? You take any business, it starts with loan from directors. And he has given a negative list of deposits. If you read the provisions of deposit rule, sub-rule 3, he says, anything and everything received by the company is a deposit except the following. So he has given a negative list. He has given some 14 items which are not termed as a deposit. If your receipt is not falling under any of that, that becomes a deposit, then you will go to actually help of complying the section relating to deposits. It is not possible for you to comply with the section relating to deposit. It says about public notice and 100 other steps. And in the penalty provisions, if you see, it is very harsh, very, very harsh. But there is a big relaxation. It says loan received from a person who at the time of receipt of money was a director is exempted from the deposit rule. Very fair. Either from the director or relative of director. Relative doesn't mean that mama, chacha and 100 others. Relative as per the company side definition. We have a very limited relatives. Our family is small family. So from anyone if at all we are receiving, it is fine. Provided, this is important, provided, he says that this provision is inserted in the deposit rules, provided facts of such receipt is disclosed in the next year's annual report. Now you have taken money, you would have repaid it also. End of the year, the balance sheet, when you send the balance sheet to company secretary, say for filing, company secretary will look into the balance sheet, balances, last year opening balance, closing balance, nil, there is no loan from director, nothing is reported in the director's report. But April he has taken a loan and June he has repaid. That disclosure, if it is not given in the board's report, but subsequently found, how do you find is also another question. Let us have a separate session on that. But if at all it is found, since it is not disclosed in the financial statement, the amount that you have received from the director or relative director is no more exempted deposit, which means it is a deposit. And if it becomes a deposit, then you were supposed to comply with the provisions of the law. Since you are not complying with the provisions of the law, it becomes a non-compliance of deposit rules, which is way beyond our capacity to comply. Bangalore ROC has adjudicated one matter wherein company had in fact received money in violation of deposit rules, and this amount was some 50 lakhs. I'll tell you, this amount was just 50 lakhs, and this non-compliance was done in the during the tough time of the company, where company had no proper consultants, no one to guide and things. We cannot expect promoters and founders to understand 470 sections of the law plus X number of income tax laws and then do the business. That's not possible. But they are also not in a position to consult professionals and do this. They did this transaction somewhere in 2018. Then they ran the company for 4 or 5 years. 2022, they were about to get some good funding from some fund houses. They did due diligence. They found this particular lacuna in their compliance. They said, why don't you do a voluntary compounding? I will invest in your company provided you get your offence compounded. And they filed a voluntary compounding application before the ROC. And you know what? The Honorable Registrar has asked the company to refund that entire 50 lakhs to the remitter. Plus, there was a penalty of 1 crore on the company and 50 lakhs on 2 directors. Which means, company first of all had to refund that 50 lakhs, which they don't have now. 50 lakhs they had received in the year of 2018 is spent for the business, right? It is not that they have received and they have kept it in the current account or savings account of the bank, some FD or something. No, they have used it for business. That money is spent. Now you have to first of all take out that money somewhere and refund it. Okay, fine. On top of that, you will also end up with paying 1 crore from the company and 50 lakhs from 2 directors. 2 crore. In fact, it is a cost of 2.5 crores. For what? For some 4 years back, some non-compliance that we had done. Any public involved? Is this a public money? Is this harm to the interest of the public at large? No. Do not expect that from the ministry at all. Hey, this is small company, nothing will happen. I am not Ambani, I am not Reliance. Absolutely, we are not in that situation. If it is non-compliance, it is non-compliance. That's it.
Why doesn't some institute, one of these, either the CA Institute or the CS Institute, take up this matter in the ministry?
And what do you mean by taking up this matter with the
It
ministry?
should not be, I mean, there should be different
It should not be so harsh.
different scales of penalty. For a small company, it should be, naturally it should
There
be
is a
lower.
provision under the law. For small companies, they said 50% discount.
No, even that is,
So what more he can do is what Vinay says. 50%, you will not get this in the shop.
no, but the normal levy is 2 If this is okay, as you said, for Ambani it may be all right to pay 1 crore to 2 crores and all that. For the smaller companies,
I agree with you, but I tell you,
I think somebody else should take it up. Because
companies
we are
are
talking about ease of doing business.
absolutely. I am with you on that. I am with you on that. But I'll tell you one thing. I am not fully agreeing with that as well. I'll tell you why. Companies Act is procedural. We speak about a lot of procedures here. There is one. This is built on a principle of one beautiful magazine, Latin magazine called Vigilantibus nor dormantibus jura subvenient, which means law helps to those who are awake, not asleep. You cannot, ignorance of law cannot be an excuse. No. And what, compliance is not costly here. You do what? You disclose. That's what I am saying. You disclose. You have prepared your report and you disclose it. That's it.
No, but this has happened by way of oversight. Judge should understand. Case to case they should take up. And in case, in fact, they should, when there is a voluntary disclosure, they should, what do you call it, they should waive all the...
That's what they did. Subsequently, they made an appeal to the higher authorities, regional director. They explained the case. But even if you read the law, even registrar's hands are tied. He don't have liberty to decide the penalty.
That's why the ministry has to do something to review the levy of penalty itself.
Agree.
And,
But again,
and the CS Institute and CA Institute can
should
play
fight for
a big
it.
role. They can play a big
Completely
role.
agree. But to what extent? Again, that's the question. No? The whole principles. I'll tell you one classic example of big difference between 1956 and 2013 Act. Under 1956 Act, for nomination of directorship, let's say for example, if you want to become a director of say Infosys, any person can nominate himself to be a director. Under Old Companies Act, there was a nomination amount of rupees 500 for nominating. This was misutilized by the so-called professional shareholders who used to say, hey, I want to become a director of Reliance, send 500 rupees DD to the company and nominate themselves. The moment when this nomination is received, what pain that company had to take? Company had to prepare necessary reports, send it to thousands of, not thousands, lakhs of shareholders, conduct meetings, and do 100 other steps, where company itself will incur an expense of some 5-10 lakh rupees. Minimum, I'm saying. Obviously, that fellow is not going to be elected as a director because he's not eligible to be director of such esteemed company. But he would do that. For what? For some ransom of some money from the company. And if company pays him off the record, he is happy to withdraw the nomination. Now, companies at 2013 came up with one point. That nomination under section 160 now is rupees 1 lakh. There are companies who said, even if I lose 10 lakh, fine, I want this fellow to lose 1 lakh, let us do the meeting. And that practice has curbed off the record of some cases. Now, apply the same principles here. If the law is not strict, if we are not vigilant in compliance, we should definitely accept the penalties that we pay. But if at all I wish to comply, the cost of compliance is not that high. All I am required to, in the instance cases, all I am required to do is disclose in the report, give it to the shareholders. It's not something new that you have to disclose. It is there in your financial statements. You have gone through that. You know this is not some petty transactions of you spending some few hundred rupees. It is a significant transaction, money taken from director. And who is signing this? The board of directors is signing this. Disclose. And hence, severe penalties.
Can they disclose it in subsequent board meetings, sir?
Irrespective of the matter whether you disclose in the board meeting or not, because that is a different section. The money taken from director is nothing but a borrowing. Borrowing is covered under section 179, which requires its own board approval and other things. Board meeting approval is not the point that he is speaking here. Disclose it to the shareholders.
No, disclosure in subsequent years reports.
No.
Not possible.
No. During the year, whatever that you have taken, you have to disclose it. And that is important. And this disclosure is required even if money taken and repaid during the year.
No, that means if you miss out on a disclosure, you cannot even revise the report.
No. Then revision has a different meaning under the Companies Act. ITR revision is quite easy from that angle. You file a revised one.
So they gave 2 years for ITR revision now.
Correct. ITR revision is possible, but ITR is different than my financial. If I need to change even a single figure in the financial statement, then that goes to revision of financial statement. I have to go to NCLT and get a prior approval before even I start revising. NCLT has to be satisfied as to why there is a revision in the report. That serious it is. That serious it is. Specifically the loan from directors.
So if you miss out on something, then the penalty is always hanging on
Just
your head.
pray that it is not noticed. Just pray for it. I'll tell you one more point. This is a significant change in the recent V3 of the MCA. Surprisingly, there was another way of interpreting this 73, which is a comfort interpretation, we call it as, like interpreting the way how I want this to be interpreted. I have not disclosed. I will anyway say it's not a balance as of 31st March. So this is a report generally generated as of 31st March. So I don't even, it is okay even if I don't report it because the balance is repaid. And there is one more form under the Companies Act that is required to be filed, is called as DPT3. DPT3 is required to be filed every year by June, July, whatever. Now, till last year, professionals used to interpret if it is not outstanding as on 31st March, leave it, no problem. This year, DPT3, Ministry has come up with a specific column, opening balance, during the year, taken during the year, repaid during the year, closing balance.
And how many years it has been outstanding? 1 year, 2 years?
The aging of this thing. Which means, it is very clear, Ministry is tracking that. They want transactions not just as on end of the financial year, no. Even during the financial year, if it is there, it is there, you have to disclose. Failing which, we have the penalties. And hence, that becomes one of the critical aspects of doing the annual filing documentation.
This loan from director and loan from shareholder also, no? Both.
Yes, loan from shareholder is required to be disclosed in the DPT3. And if loan from shareholder happens to be a relative of director, that shareholder happens to be relative, then it has to be also disclosed in the report, the board's report. So, at least the way how in our office, what we have practiced is, this is a standard checklist. Whether or not that is disclosed in the RPTs, we have a separate questionnaire to be sent to the company. That please answer is if there is any so and so. And we in fact take out a director's ledger. Director's ledger, we ask them, we say that you send it to carry ledger of director. Then we decide. Because I cannot, looking at the recent ROC adjudications, I cannot just rely, hey, company has provided this, I certified. No, it has You as a professional who should have exercised the proper diligence. And looking at the intention of ROC's ministry, basically Minister of Corporate Affairs, I find no reason that they should not even put the professionals behind the bar for even a small mistakes. Leave about the company and directors. Right?
But loan from shareholder also is not a deposit. No?
Loan from shareholder is also one of the exempted deposit. If it is within the limit. See, there is a 5th June 2015 notification, 17th June 2017 notification, and recent 2019 amendments. These 3 amendments collectively says certain categories of companies can accept any amount of loan from shareholders, but if you are not falling under that category, you can take only up to paid up capital and freeze loan, which is your net worth. You can take loan up to your net worth. Net worth would be hardly what? Say if you have 1 lakh capital, and hardly most of the companies will have a loss in case of startups, and you don't have a net worth. So you cannot just take loan from shareholder, and shareholder loan is not always exempted like director's loan. Director loan is without any limit, without anything, any restrictions, it is exempted if it is disclosed in the annual report. Whereas not shareholders loan, you have to fall under that category, and it is not easy to be under that category on this.
What circular is said?
5th June
Loan from
2015.
shareholders.
5th June 2015.
That is for private companies exemption.
For then again 2017 notification also.
Right.
These 2 notifications,
So private companies are exempt in that sense.
if they satisfy certain criteria, leave it in that notification. There are 3 conditions he has mentioned. If you satisfy, then only it is exempt. Otherwise, it is not exempt for even private companies. Right? Moving on to the next important point, which I, as a practicing company secretary, have seen in some of the financial statements repeatedly, is shareholding pattern change. Wow. Why this is a critical point for us, specifically for chartered accountants, while doing the accounting and audit. Now, this shareholding pattern is a non-financial transaction again, and we are always focused on financial transaction. Then what we do, we prepare final accounts, the balance sheet and P&L account. Then company will also prepare notes to account and other things. And in the notes to account, there is a schedule, capital schedule. Capital schedule we give shareholding of promoters. There could be 2 types of mistakes here. Mistake number 1, there could be a transfer of share by promoter, founder, and top 5 shareholders, 5% shareholders. So they would have transferred the share. This is not a transaction of the company, this is a transaction of individual shareholder, and we might miss it. We might, in fact, miss it. So last year, whatever it is there, you would have just carried the same shareholding pattern in the. This is one of the common mistakes that could be possibly done in the financial statements, schedule, share capital. There is another mistake. Even if we take care of this, there is another mistake generally we do. What is this mistake? Change in the percentage of holding. I will ask my promoter whether there are any share transfers during the year. Have you transferred your shares to anyone? He will confidently say, I have not transferred any shares to anyone, and I continue to hold the same amount of shares, same number of shares as I was holding in the previous year. Fine. But that company would have issued new shares. There could be dilution in the shareholding, which has led that he would have previously held 50% share, now he is only 45% shareholder. We miss this to notice, and we would have just signed the same thing. No, we cannot do that, because this is a non-financial transaction. In our audit checklist, in our accounting checklist, we have to have the specific question whether there is any change in the shareholding in terms of number of shares as well as percentage of shares. Moving on to the next critical point is performance of subsidiaries. So we have to give a disclosure in the annual report, in the body of the report, not as attachment or anything. Disclosure of performance of each of the subsidiaries. Now we give annual report, we give company is doing so and so profit, so and so loss, whatever it may be. Last year turnover was so and so, this year turnover is so and so. We have given this overall performance of the company, and the director's report is always prepared based on the standalone financial statements. But if the company has a subsidiary, there has to be a separate section for each subsidiary how their individual performance is. Did we do that? We missed. This is again a law. This is required to be disclosed in the financials. Sorry, in the board's report. So this is one of the critical aspects. If the company and subsidiary disclose the performance of each subsidiaries, not just at a consolidated level. No, each subsidiary 1 did this, subsidiary 2 did this, subsidiary 3 has a loss, subsidiary 4 has a profit. Disclose it. Next, important is POSH compliance, POSH disclosures. Again, this is another classic example of some other act having impact on the board report prepared under the Companies Act. Prevention of sexual harassment of women at workplace is one of the important legislation that is implemented in India. To our surprise, this act is applicable to all entities. If there is a workplace, there is a POSH Act applicable to all. Second surprise, company has to constitute ICC. Act is applicable the moment when you have a company. There is no exemption for applicability of Act, which means you should have policies and everything in place, though you don't have any employees. Fine. Second surprise is the company having more than 10 employees are required to constitute a ICC, and this is where the joke starts. ICC should have majority being women employees and should be chaired by senior women employees. What if I don't have women employees in the place in the company at all? Doesn't matter. You should have ICC, and ICC should have more than, like, majority of them should be 2 out of 3 should be women employees. Now you have crossed 10 employees, which means you have to mandatorily hire 2 women employees now, constitute ICC, make them part of the committee, make them chairperson, and then do compliance. Failing which there is a compliance, non-compliance of POSH Act. Sir, logic doesn't apply again here. Non-compliance, if there is a non-compliance, we can give proper explanation. Of course, the non-compliance is not under the Companies Act here, it is under the POSH Act. Then I'm sure 100% this can, the case, if at all picked up, could be explained before the District Commissioner of Labour and explain him that there are no women employees, blah blah. But barring that, if company has sufficient number of employees in all, it is required that company should have the POSH policy and also have ICC and disclose such facts, including salient features of my POSH policy in the board's report, including constitution of committee, who are all members of the committee, number of complaints that I have received, number of complaints resolved, pending to be resolved. These disclosures, of course, this is part of the POSH annual report that we submit to the DC, District Commissioner of Labour. But in addition to that, Companies Act board report, the annual report, this is applicable only if the entity is a company. POSH is applicable to all units, even for proprietary concern it is applicable. But for company, the annual report should disclose these facts. Failing which, there are, I believe there are a number of adjudications for non-disclosure of POSH related points in the annual report. Hence, this becomes an important point. And these days, one of the active cases that I am presently handling, the District Commissioner has specifically sought, after a complaint that is being raised by one of the employee, District Commissioner has specifically sought the annual report filed under the Companies Act to be submitted to him for last 6 years, to see how many complaints the company is generally getting and how it is getting resolved. And if it is not, then he has a problem with that. Right? Next important disclosure is CSR. Very hot topic these days. We know what is CSR. I will not get into much into what is CSR and all. But the policy, CSR policy extract has to be disclosed in the again annual report, again critical point. If there is a insufficient spend, now CSR is a, previously it was comply or explain principle. Either you comply or you explain why you could not comply. But it is no more a comply and or explain principle now. You have to comply. You have to spend before end of the financial year. If it is pertaining to ongoing project, and you could not spend for whatever the want of requirement of the industry, then you can spend it over a period of time, but you have to park that CSR contribution, the separate account before the end of the 30th day from the end of the financial year, that is 30th of April. There is one more remedy he has given. You have no ongoing project, you have not spent the CSR amount, still okay. He has given 4 funds like PMKs and other things and all. Before end of 6 months from the financial year, you can remit the funds to those accounts and only those accounts. But there is a question now. I have not spent my CSR before end of the financial year. I have remitted that money to say PMKs on 1st of April. Should I consider this as a compliance or non-compliance? Any thought process?
Not spent.
CSR is not spent as on 31st March.
So that is the fact.
So that is the fact.
Yeah.
Absolutely right. As on 31st March, did he spend? No. So there is a non-compliance. The auditor has to definitely qualify this as an observation that the company has not spent. However, board can take a stand and explain as a response to the queries or qualification of auditors in the board report that though the company could not spend the money on or before 31st of March, but post the financial year, company has remitted the money to so and so fund and hence has complied with the provisions of CSR. That would be an umbrella that the company can take. Having said that, that is not the sufficient compliance of the law, but that is definitely an escape route from the penalties. Having said that, as auditors, as professionals, from your qualification point of view, if it is not complied on or before the end of the financial year, it is not complied and there has to be an observation/qualifications as per the requirement.
Any reason has to be given for that? Why it was not spent?
Yes. Yes. Most of the companies, first year they said, first year applicability, we could not concentrate on CSR spend. Second year they said they could not find the suitable project. I am telling you the common reasons. Third year they are left with no other reasons but to say sorry. Because you cannot drag this much, because previously, as I was mentioning, it was comply or explain principle. Now it is like you have to create provision. As auditors, as accountants, we have to create provision for that and we have to spend. We should ensure that it is spent before 31st March of the next year. If it is not spent, it can go to only specified funds.
Before 31st March, if we transfer to that account, is it called spent?
Definitely, because the schedule has given some of the list basically, and one of that is obviously PMKs, and it is considered to be a spend. The next one is last point in my disclosure perspective in the report preparation of documents is website disclosure. Of course, website disclosure is a big list, not just one or two. There are a number of items you have to disclose in the website if the company has a website. So these days it is better not to have a website than having a website. That's how the perspective is. In fact, one of my clients today expressly said, we don't own a website, our holding company's website, we have a web page in that website, so it is not called as, he has gone into the interpretation, what is website and what is web page, and he has taken a legal opinion also. Because he cannot afford to disclose all those things in the web page that he has got. So he says, hey, I www.xyz/xyz India is my web page, it is not website, so I need not disclose. If you have a website, you have to give number of disclosure. When it comes to annual filing compliance, there are two important points that I have to draw your attention. One is you have to upload the AGM notice, for that matter in general meeting notice in the website, and you have to also upload the annual return, which is the Potential 7, and give the web link of that in the board's report. If you have a website, take care of this. Extract of, previously there was a concept of extract of annual return, even now that is done away with, no extract, nothing. You have to have the web link of the annual return where it is in. Some companies came up with a crazy idea. What they said is, the company has been regularly filing the annual returns in the ministry's website on www.mca.gov.in. Interested persons can view the same from that website. Is it a sufficient compliance? That could be a sufficient compliance if mca.gov.in is your website. Unfortunately not, no. So the website, the web link of that should be from your website, not mca.gov.in/public documents. No, not that link.
No, if I post it on Amazon website, I cannot give Amazon website link then.
It has to be your website.
If I posted my report on Google Drive, I cannot give Google Drive link.
It has to be a link. Of course, it can be stored in Amazon server or say Google Drive server,
Yeah.
and link that server to the web page,
Yeah.
website page, and give that link. That is still a
So
possibility.
similarly, MCA, my report is uploaded on MCA website. I give that link here.
No.
Not
I'll
possible.
tell you why. Because public documents are subject to you making certain payments. You click that button, that should appear. Is it happening in the MCA website? No. And that is not your website. Point is that
I'm not.
there are third-party websites which can actually, where you can actually see the, these things.
No, what I'm telling is whether the link should be, whether the upload should be on my own website or it can be on any other website.
See, ultimately, it is your website.
No, if I give a Google Drive link, whether it is valid or not.
That's what I'm saying. The website, the page wherever you say www.xyz.com, there you probably have a page called say corporate information. There you will say annual return. Now that link, once it is clicked, it can go to anywhere in the world.
That's what I'm asking.
Yes. Because the entire web page for that matter is built in that way. If you technically see, the web page is nothing but number of links fed into it. No company will have its own servers. Say they would have bought the server, web page, rented from GoDaddy and 100 other things. And they will feed the information there which will be redirected to your page. That's how the website is built.
No, what I'm saying is if I create a startup where all the annual reports are there, and if I give a web link to all the companies, then it's a sufficient compliance.
Their website should have a link which can direct you to the relevant annual return. So it should start that way. Right?
So subscription for private limited companies also.
Yes. Any company having website. That's why I just said it is. You should definitely look twice now. Should we have a website or? So interesting fact came. Does Flipkart.com is a website of Flipkart, right? And we don't see corporate information over there. I'm deviating. I'm sorry, but I'm still taking up this question. Surprising, one of my clients also has the same product. For him, the definition, again the interpretation here is, no, Flipkart.com is not a website of Flipkart. No, it is not. It is for them, it is a product. It's a platform for them. It is not a website where they disclose all the information. No. You need not have it there. You will not see Flipkart website where you don't see corporate action entities. No, you don't see it. Amazon.com for that matter, if at all, if they it's not. So there is a difference between a web page and your online platform. Online platform could be different than the web page, website. So,
What is the definition of web page and web link?
Web page and web link. Web link is the specific address to the particular page. Whereas web page is one of the page in the entire website. Website is a larger book, whereas page is a single part of that.
And
That's why we.
And the compliance is, if we have a website, we have to.
Yes. Say for example, there are a lot of companies, specifically foreign subsidiaries. They might not have their own Indian website as such. They have a global website, and they have an Indian page. Like many other countries, they have an Indian page. Now that is not termed to be a website.
Need not be disclosed.
Need not be disclosed, because for many reasons that page is not even controlled by this Indian company. It is not even. It is a page owned by the parent company abroad, having their own website, giving disclosure about their subsidiaries worldwide. And Indian company generally uses that page as its disclosure for all marketing purposes and 100 other things. So that is web page and website differences. Website means you own that entire website, World Wide Web, www. whatever. Right. So these are all the critical points, important point. We have spent 1 hour 40 minutes on that itself. As I was mentioning, that's what my intention was also, to press upon more on the documentation part. Now we will move on to the critical aspects of procedural aspects. Maybe we'll spend some 5 minutes and then again 5 minutes, 10 minutes on the filing. So while doing the annual filing, what are the things that we have to consider? First thing that we have to consider is, do I need a AGM extension? Why do I need a AGM extension? These days we have UD, which means quote unquote there could be no possibility of you being backdated off the record more than 60 days. Right? And we have a requirement of completing everything and doing filing. And if it is not done in time, we know per day 100 rupees meter will start. So is it wise to actually apply for extension of AGM? There is a provision under the Companies Act where you can apply for extension up to 3 months, maximum 3 months, after giving sufficient reasons, valid reasons. Now reasons should be convincing to the ROC. Now how do you convince is left to you. Now, what are the general reasons generally when people go for extension? Say for example, first time adoption of Ind AS, change in the management, change in the statutory auditors. The reasons which could lead to delay in finalization of accounts and approval of accounts could be the valid reason for you asking for extension. Just like that, I don't feel like having a board meeting now, why don't we have a board meeting in the month of December? No, this is not going to be the valid reason. So the reasons should be satisfactory to the office of ROC so that they can give an extension. So you can plan for extension if required. Anyhow, for this year, this is an irrelevant point now because the time period is already over. You have to apply. This extension has to be applied not after the due date, before the due date, right? And next one is we have and very important point in the extension of AGM. I forgot to mention this. AGM is required to be held before September is what generally our mindset is. One of our client has received a notice somewhere in the year of 2021. This is a system generated notice. Why? Because they had somewhere in the 2017 conducted the AGM in the month of May because of non-availability of directors and shareholders. They went to some foreign countries and all, so they were not there in India during September. So the AGM date is shown to be in the month of May. That year compliance is done. Fine, no? In May also you can sign there was no UDIN concept at that time. They paid some additional fees penalty and they completed the filings. Next year they did it in the month of September. What wrong? AGM has to be conducted within 6 months from the end of the financial year or 15 months from the previous AGM, whichever is earlier. They had to conduct the AGM before August. They conducted in the subsequent year in the month of September. Why? Procedural lapse. 4 years later, they received a notice from the ministry and they had to go for a compounding of offence. Had they at least obtained a extension, this could have been avoided. So plan for AGM extensions in the coming years in case if it is required. Next one is auditors to attend the AGM. If you are signing 20 audits, quote unquote, out of the 20, at least 18 will be having AGM on 30th of September. And how do we manage this? Can I say no? Generally when people invite to their home, house for dinner, whatever it may be, we can always say, hey, I am busy on that day, there is filing for me, I cannot come, sorry. Why don't you allow me to be absent? As auditor, do you have that flexibility of saying no, sorry, thanks for inviting? No. Absolutely not. It is one of your duty to be part of the AGM. And why you have to be part of the AGM? You don't have any voting rights. To answer the queries of shareholder. Being auditor, shareholders can ask questions to you. There could be auditor session in the AGM. Questions to you and you answer to the shareholders, and for that purpose you have to be present in the AGM. So next time you sign the audit engagement, include this point in the audit engagement and accordingly quote your fees. What fees? Auditing charges so and so, and attending AGM charges on 30th of September if it is so and so. Right? But there is one relaxation. Unless exempted by the company, auditor has to attend the meeting AGM unless exempted by the company. Now the question comes, there is nothing further than this, okay? No clarification, no circular, nothing. This is the only language that is used. What do you mean by company exempting the auditors? Lot of companies have taken a stand that board of directors in their board meeting, they simply passed a resolution saying that auditors are exempted from not attending the meeting. And many auditors, because they could not attend the meeting, they insisted that unless you give this exemption, I am not going to sign your report. They gave this exemption by passing a board resolution. Who are board of directors to exempt auditors from attending the shareholders meeting when the meeting is for the shareholders? No. Though the law is silent with respect to how auditors should be exempted from attending the meeting, it has to be shareholder who should be exempted. And what are the means of getting this approval from the shareholders? There are certain companies, smaller companies, who generally take a written approval from them, stating that I don't have any objection for auditor not attending the general meeting. Many companies have passed a ordinary resolution in the shareholders meeting, because unless specified under the law, all resolutions should be passed in the ordinary resolution basis. Majority prevails, force versus water rule. Now, under this category,
But it will be a special business, sir.
it will be a special business.
Then they should explanate the statement at all.
If section 102 is applicable, yes. I mean, if private companies have exemption from giving the explanatory statement if their articles are providing sufficient clauses, but yes, there has to be explanatory statement for it. Many listed companies have done this also. Many listed companies, if you can search in Google also, I thought of having it, but I don't have it right now. Many listed companies have specifically passed a resolution exempting the auditors to attend the meeting. Exemption doesn't mean again prohibition. No one can stop you from attending. It's only an exemption given to you. It's not mandatory for you to attend. You can at that time say, sorry, I am busy, thanks for attending. But not in any other case. So make sure before accepting the audit engagement that you have this exemption. One critical point for auditors. You have this exemption. Whether or not you attend, it's not that you cannot attend. Yes, sir.
Sir, can the resolution be passed in the AGM itself? That we have received a communication from the auditor.
Brilliant question.
He's not able to come.
Brilliant question. Brilliant question. Any answers from the audience? To be more specific, correct me sir if I am wrong. I have called a AGM. Auditor is not attending the AGM, and in that AGM I am passing a resolution.
No, but AGM will not have any other matter kind of thing. No, for board meeting we put that any other matter.
Absolutely. So that answers the question. AGM, you cannot decide anything unless it is scheduled for. No other items. Unlike board meeting, you cannot take any matter with the permission of chair and majority of the directors. AGM, only specified agenda can be done.
Notice should specify.
Notice should specify, correct, absolutely. Point number one. And point number two, even if the notice is specifying that agenda, to start the AGM, auditor, if he is not present in that AGM, that is not a valid AGM. You are getting my point? So you pass a EGM approval, special business, get a ordinary resolution passed, exempt the auditors, and then have the AGM with the relaxation of auditor not attending. Not before that. No. There is also a relaxation. Auditor need not himself go to the AGM. He can send any of his teammates who are qualified to be an auditor. So not your articles, trainings or anyone. He has to be qualified to be an auditor, which means he should be a CP holder again. Then he can attend on behalf of you if he is your associate or your. Otherwise, plan for attending the AGM in multiple places.
So this becomes a professional opportunity.
This definitely is a professional opportunity. That's why I said, your engagement should have fees for these two separately.
Some person can be working only as a partner, associate.
I don't think that is a good professional opportunity, sir. I don't think no auditor would just want to be a person who attends the AGM, but I reserve my comment on that. Next point is, one more suggestion we have for private limited companies is quorum to include proxy. Generally, proxies are not counted for quorum, number one, and they are not allowed to speak or vote in the show of hands. They can vote on the the paper, but not on the show of hands, and they are not counted for any quorum. Many a times, private limited companies having only 2 directors will face this quorum issue. One of the directors is out of India during, say, September. And how do we manage that? And you have to have AGM. Luckily, we have VC concept now. But in case VC is not possible for some reasons, now that VC is also extended for 1 more year now through circular, but video conferencing is not possible, then how do we manage? There is again 5th June 2015 notification which says that section 1012, section 107 and section 109 need not be applicable for private limited companies if your article says so. So if you are incorporating a private limited company, if you are having a private limited company as your client, why don't you just suggest them to amend the articles and have this, that even proxy can be counted as quorum, no problem at all. That the founder, directors travel around the world, somebody who is in India will be a proxy for them, and that proxy can be recognized as a quorum. Yes.
On this quorum issue, I raised it out some time back. There are only 2 shareholders. Then the thing is, AGM is called. So if quorum is not present, generally the meeting is attended for a week on the same day of the next week.
Yes.
On that day, whoever is present, it forms a quorum. So next week, only 1 person is present.
Subject to minimum of 2.
Is it there?
Yes. So meeting means unless there is only one exemption, which is
1 person.
court ordered 1 person meeting. 1 person company leaves, there is no meeting at all there. It's only minutes. Court can order for 1 person quorum. There are many, like say dispute resolution related cases, operational mismanagement cases involved. Generally, court orders that so and so resolution can be passed by the company, and for this purpose, if it is spread, I am saying, even 1 member attending will also form a quorum. Court will order. So subsequent meeting is subject to minimum of 2. Without having minimum 2 members, there cannot be meeting. Yeah. Otherwise, there cannot be no meeting, sir. I come and I go, no meeting. Who I am meeting, right? So that is not possible. Yes. So next one is holding of AGM in different cities. This is a miscellaneous point, but I wanted to highlight you. Generally, we take shorter notice consent. It says 95% in case of AGM and 90% in case of EGM and all. These days, you can also hold the AGM in different cities if directors are sitting in different places. Say more specifically, for example, the registered office of the company is in Maharashtra, the auditor is in Bangalore, and that is 30th of September. You want to have financials signed on the same day, AGM on the same day, everything on the same day. As we have seen in the beginning of the discussion, let us not take the chance of having different places for financial statements, board report, AGM and all. So everything is happening in Bangalore. Because the AGM is happening in Bangalore, whereas the registered office is in, say, Mumbai or Pune or wherever, you have to take a specific approval of shareholders. And this time, he says approval of all the shareholders, which means you need to have another item, unanimous consent of all the shareholders to have meeting outside your city limit. Within the city limit, no problem. Outside city limit, if you are having AGM, you need to document the 100% of approval. And the fact of this should go as part of your notes to notes. In the notice you are giving, there you have to give a fact that this AGM is being held in so and so, and pursuant to so and so provision, consent of all the shareholders is necessary. And question now arises, where should I obtain the consent? Like, should I obtain the consent in the AGM or on the date of AGM, previous to AGM? Ideal method is definitely previous to AGM. This is like a shorter notice consent. So you have called for a AGM. If you don't have 100% consent, you cannot conduct the or convene the meeting. Meeting has to be deferred. So these are all some of the points that I wanted to highlight on the procedural aspect. Now just 5 minutes on annual filing requirement, the filing procedures. What kind of document that we end up with filing? Very simple, obviously. In case if VC meeting is held, video conference meeting is held, the resolutions passed with the complete details will have to be filed before the ROC separately in MGT40. Now what do you mean by this separately in MGT40? Let's assume you have a meeting for approval of increasing the authorized capital. You will anyhow file a form called Form SH7 and all, right? That is there. That is say compliance for that respective agenda item. Additionally, if meeting that resolution is passed in a VC meeting of shareholders, separate MGT40 is required to be filed within 60 days of, this is only one item where you are given 60 days of time. Otherwise it is always 15 days or 30 days. Within 60 days of AGM, you have to file a document for MGT40. Generally, why this is important is we take flexibility of saying that hey, director is in Switzerland, I will pass a VC meeting. It's not sufficient. As I was saying in the beginning, expressio such exclusio ulterius. What is not expressly expressed, it cannot be implied. If it is VC meeting, you express it by filing a MGT40. Otherwise, you have tough. Then obviously we have AOC4, AOC4 XBRL for applicable companies and MGT7. For smaller companies, we have MGT7A. Then comes
that AOC4 still in V2 only.
AOC4 luckily is in V2. I should say this.
MGT not in V2.
Yes, all these annual filing returns are in V2 as of now. Ministry had at one point of time, somebody in the July said by September they will also implement V3 for annual filing, but luckily for their inability to implement it, we are safe as of now, but we don't know about the next year. Next one is OPC filings. Generally, all these forms are required to be filed the companies are required to file within 30 days from the date of their AGM. So if AGM happens to be in the month of September, by October and November, you have to file AOC4 and MGT7. And we continue to be in that mindset. Whereas in case of OPC, we forget that there is no meeting. And since there are no meetings in the AGM for OPC due dates will be in the month of September itself. Now some of you might be remembering, oh, you have to file for that OPC. Yes, OPC filings and filings will be in the month of September, and for other companies it is October, November. And apart from this, we also have corporate action filings. Sometimes your directors could be retiring, you have to take care of that. Auditors are retiring. This is one funny part. When this rotation of auditor came for the first time, everyone appointed them and they were in peace of mind for next 5 years. Problem started after 5 years. Because for first 5 years it was easy. 2016 I appointed, no, 2021 fine, no problem. But somebody who has been appointed in the year of 17, 18, 19, they are getting in 22, 23, 24. No, it's not like after 21 again this headache will come after 5 years. No. Every year for each company, it has to be checked whether auditor is retiring or not. And what happens if ADT1 is not filed, his retirement is not done? One important point is, as sir mentioned, if auditor reappointment point is not taken in the AGM, this is one of the ordinary items of agenda, not taken in the AGM, you cannot conclude that auditor is reappointed. So that has to be taken in the AGM point. Very cautious while doing while drafting the notice of AGM. That has to be taken care. If not, that means company does not have any audit and next year audit is not possible. And I am sure when V3 comes into picture, if you put the SRN of old ADT1, it will not even allow you to file the form because it says this SRN expired. Where is the new SRN? Not there. Where we are deadlock. Right? So very important. Then, yes sir.
Appointment of auditor in case of OPC, AGM. There will not be any age limit.
Still 81 is required to be filed based on the merits.
So within 15 days criteria, from which date do we need to consider?
We are generally considering September.
September.
End of year. Basically, that is the OPC provision. What it says 118. If you read it, it says the minutes should be drafted in case of OPC and submitted to the company. The date of submission is what something that we are taking as a date of meeting, similar to the date of meeting, and then submitting it. Then not just these files. Your AGM need not only have the ordinary items; it can also have the special items. Any special approvals related to transaction approval, things like that, and you have to take care of necessary filings before that as well. Obviously, today's session was not about what compliances we will end up in doing. No, we are all past that. We have 10 years of new law, so we know what compliances are required to be done. I have made a small effort of bringing some of the critical aspects of annual filing points that we have to observe while preparing and finalizing the documentations. And all this, as I was mentioning in the very beginning of first sentence of my speech, that nothing that I am going to mention is something new to any of you, but probably that is some critical in a different way, different approach. And why so? Because we knew it yesterday, but we are not practiced that today. We will become unaware of that tomorrow. Irrespective of what amount of professional experience that we have, because of this vivid and changing law, very dynamic law, unless we update ourselves on a daily basis or regular basis, we will definitely become illiterate in the profession. So, wishing all of us that one success of updating ourselves in the relevant law that we are in. I am concluding my discussion, and I have taken 5 minutes extra of all of you. I'm open for any questions now. Right, I take that as yes. One.
Sir,
I'll just take that.
mentioned about the standard checklist. Could you make it available anywhere?
I would, of course, I'm happy to help, definitely. These are my credentials. I'm reachable otherwise professionally. So you can let me know if you have any questions, any point of time, definitely. When it comes to checklist, can we have a standard checklist? One important point, and the reason why we had a 2-hour long session is all these are tailor-made. There is nothing called standard here. As I was mentioning, if this is applicable, this is applicable. So, unfortunately, there is nothing standard. The standards are only AOC-4 and MGT-7, and we have to just fill in that. The rest, everything is read the law and comply and pray for receiving no notices. Sir.
Do we have any publications for non-compliances from the institute?
I'm sorry?
Like standards of quality control. Like for audit report, the ICI has brought out a book. Wherein they say that when you are doing 44 AB audit, these are the non-compliances part of it. So when you do the audit, look into these critical aspects. Similarly for company filing, do we have any board like that?
Fortunately, this is not an audit, this is a compliance by the company.
No.
Right, so ministry is not giving any separate list of things to be observed.
No, CAG brings out a report wherein they say these are the non-compliances by the ROC. These are the things which ROC has to look into, but they have not looked into.
No sir, no, nothing such. Nothing such. Because we have 470 sections of the law which are applicable, and everything has to be checked into. So there is nothing called specific important areas where I want ROC to concentrate and report. No, there is nothing. Of course, if you look from the ROC's work point of view, 2017, 16, 17, 17, 18, he has started a drive of disqualification. Like he has catch hold of those companies who have not done the filing of returns for 3 years. Then subsequently he has called for 1 year, he has called for CSR. 1 year. It's like an income tax is coming after angel taxation 56 to 10 and things like that, one particular year. Next year we are little lenient on that. Things similar to that, but it's not standardized. Sir, you had a question?
for a new company who wants to raise funds, what they are doing is that they are giving 100 shares to a person and then taking a loan from him. It's a private company. Is it a problem, or how do we avoid that, or how do we comply with that kind of thing? Because they need money, people are willing to give money. Banks and they are not giving. How do we avoid?
I'll add to that one point. In fact, at least in your case, you are giving 100 shares. In some cases, I have seen they have taken the exemption from directors. It says very specifically drafted words. Loan taken from a person is exempted, provided that that person happens to be a director on the date of giving the loan. So somebody have appointed an individual as director on say 1st of April, taken loan, 2nd of April he has resigned. Is it a non-compliance? I would say no, not. If you go by the literal interpretation of the law, it is not a non-compliance. But definitely we are opening our doors for, ministry to look into more of our compliance.
No, but then who else will give him money? Nobody else will give him money.
Yeah, but it's not non-compliance. Definitely it's not a non-compliance. You can. There is nothing hard. And as you rightly said, for businessman, business comes first. And law, I am happy to say second, but sometimes it is not even second. And we are long.
No, sir, that's not the issue. If I say don't do this, I should show him some other way.
So exactly, as professional you say, we cannot just say negative word. We should say, okay, if this is not right, do this.
Something
But
else, no, but there is
we
not
don't have any
any
other option.
money for him.
I completely agree. But it's not a non-compliance.
Sir, somebody can be a shareholder, can be a director without shareholding. Sir.
Yes.
So somebody can be appointed as a director and loan can be taken.
Yes. Absolutely.
No need to allow shares.
Absolutely. But this cannot be done as a post-mortem job.
Yeah, it has to be.
Because that fellow has to have a deal on the date of
Yeah,
appointment.
that's
Right? But yeah, yes, possible. I can become a director today and give loan tomorrow and resign.
I don't have to. I can continue also.
I don't want to continue because the position of director is very.
Yeah,
It's not a
you are right.
desecration to be. It is a. For lack of words, it is not a place to be there. Considering the applicability of law, specifically in the business where I am not involved, I am not a decision maker. Yes, ma'am.
In case where a company has not taken the extension of AGM, apart from paying the late fee, is there any other consequences?
Yes, of course. Late fee means you have conducted the AGM in time. Have you conducted the AGM in time?
No.
If the AGM is not conducted in time, then there is no late fee. Let's assume. Okay, good question. Question is, AGM due date is 30th of September, but I am not able to conduct the AGM on 30th of September. I am doing it on 1st of January next year. And I am filing it immediately after that. AOC-4, no additional fee comes. Because AOC-4 is being filed within 30 days of AGM and your AGM is on 1st of January or 31st of January, whatever. MTT-7 there is additional fees. Because MTT-7 fee is calculated not from the date of AGM. It is from the date of AGM or the due date of AGM, whichever is earlier. So due date is calculated accordingly. In such case, additional fee is a lesser burden, I will tell you, madam. But there will be a multiple section violation. Section number 1, you have not conducted the AGM 92, 96 and all is annual return and all is, there is a violation. There is a section called 129 which says that company has to present the financial statements before the shareholders within 6 months. That also you have not done. That is also another. So like this multiple section violation will happen. One answer to that is compounding of offences. Condonation.
Can we take the consent of the shareholders in
No.
subsequent?
No.
Compounding.
It has to be compounded. It has to be compounded.
AGM is conducted within the due date, but AOC-4 filed after the 30 days. So only the late fee is the penalty, or any general penalty will be levied under that section?
Sir, answer is in your question itself. Late fee is not a penalty. Late fee is just a late fee. Penalty is prescribed under the Act, which is 500 rupees per day. 100 rupee per day is not a penalty. Please try to understand this. 100 rupee per day is an additional fees. It's not a penalty. Penalty could be levied by the registrar based on these delays for the delayed period at a rate of rupees 500 per day. But at least I have not come across with any instances of registrar levying that penalty once the company has already filed the returns.
Any limitation on the time period to levy the penalty?
No, under the Companies Act. I have to specifically check under the Limitation Act.
No, if the violation is 2016, Whether we will get it this year or
Sir
not.
is remembering one of his character. Yes, sir.
Huh?
No, not under the Companies Act. Not under the Companies Act. I will have to check and come back on the limitation act specifically if there are any limitations, but not under the Companies Act.
In a meeting, one director is located in India and attended the fiscal. And one director who is staying in abroad gave a request for a virtual meeting, and board meeting is completed. Whether MGD 14 is required.
Board meeting, VC meeting, if it is conducted through video conferencing, MGT 14 is not required. Only the shareholders meeting, if it is conducted through VC, MGT 14 is required. And in such case, even one person participating in the shareholders meeting through VC, if company has provided a VC facility and somebody has used it, MGT 14 is required.
In the website, can we protect the file with password and circulate it with the...
What is the purpose?
Circulate it to the shareholders.
Now, the intention is not to give it to shareholders, the intention is to give it to general public at large. And it cannot be password protected. In such case, you could have sent it to shareholder only, no, directly. And shareholders, anyhow you are sending it. Shareholders, as part of your annual package, you are sending it. You cannot password protect it.
So all the companies now which are conducting their AGM through VC, they have to file entity code.
Yes, within 60 days. Yes, thank you very much for your patience listening and giving this opportunity. Thank you.
Members, after doing all the hard work for whole year and got audited from internal auditors, external auditors and whatnot, and then comes the Compliance Under Income Tax Act and then Companies Act, whatnot, and what aspects which critically need to be dealt with by professionals like us, chartered accountants. Since we certify many things under various laws, especially with respect to MCA, and ROC is no longer the approving authority but a strict regulator. We need to be careful. So my fellow members, as dwelt upon by speaker, be vigilant so as to avoid fines and penalties for the companies you audit and yourself as auditor or consultants. With that note, let us give a round of applause for the excellent discussion. On behalf of members present here and all the managing committee members of Bangalore branch of ICI, we would like to hand over a memento as a token of gratitude and respect. Can I request SCA Jayant Kumar sir to come out to this and then do the honors. Thank you, sir. Thank you, one and all. Keep supporting Bangalore branch.